All right, well, it is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. It is that time where we bring in a community member and an expert to get the community member's portfolio pimped. And today we have Noah joining us. Noah, welcome.
Howdy guys, how are we going?
Very well. Thank you for submitting your portfolio. And our expert in the studio today is none other than Adam Dawes. Adam, welcome.
Great to be here, guys.
So, Ren, as always, let's kick off. Can you explain Noah's portfolio?
Yeah, so Noah has a portfolio of ETFs. The biggest holding is the iShares S&P 500 ETF, about 35% of the portfolio. The Vanguard Aussie shares, next biggest, about 16%. And then Vanguard Diversified High Growth at about 13% of the portfolio. But we do have a number of other ETFs here. We've got the Beta Shares Diversified All Growth, FANG Plus, Global 100, Aussie Property, India, Asia ex-Japan, and NASDAQ 100. So a number of ETFs. We've got some crypto, a bit of Bitcoin in there, and then a few mining companies, Latin Resources, Rio Tinto, and MinRes. So Dawsy, we always start with a bit of a nickname. Do you have one for this?
Well, Noah's going to save us on this one for the ETF boat that's going to be floating along there. So Noah, well done on the diversification of your ETFs.
Thank you.
So Noah, do you want to tell us a little bit about how you built this portfolio, how it came to be?
So the first two are obviously the iShares and the Vanguard, which everyone jumps into normally when they get started investing. But probably about 3 years ago or 4 years ago when I started, I feel like there was a new flavor of the month every couple of months with ETFs coming out. And I was like, oh, okay, that looks good. I'll get some of that. That looks good. I'll get some of that. And then it's kind of just 4 years down the track. I'm like, I've got everything. So it feels a bit, especially I'm heavily weighted towards Australia. So there's a bit of that homegrown bias, which I know is a bit unsafe. But I think I may have been caught by that analysis paralysis and over diversification in some areas.
Well, look, I think the good news is you're certainly not alone. I think a lot of investors become sort of ETF collectors, and there's always a new flavor of the month because there's so many. But Dawsy, when you see clients like this, how do you counsel them?
Yeah, so it's an interesting one, and Noah, well done. Like, it is a well-diversified portfolio, but I think potentially it's probably too diversified. Does that make sense?
Yeah. 100%.
Yeah, you've got lots in there. Obviously, the IVV is the standout because if you bought that 4 years ago, you are well in front on that. So comfortable with the percentage basis that you've got there, albeit it's probably a little bit high. Potentially, you might want to sort of bring those percentage weightings down a little bit, and then diversify that money into something else. So that would be sort of not really concentration risk, because I think you're pretty safe in the S&P 500. Let's be honest, it's been fantastic. It's coming a little bit unstuck now with what's going on in the US and things like that, but the growth is still going to be there. So you're okay with that. Some of the other ETFs are sort of more index based, the FANGs and the FTSE, and then so you've got the Global X FANG, and then you got the Beta Shares NASDAQ 100. You need to lift up the hood and have a look inside there, but I suspect they're pretty much going to be the same kinds of businesses in there as well. So you could look to sort of consolidate some of those ones that are like for like as such. So in other words, the Vanguard Diversified High Growth and then the Beta Shares Diversified All Growth, you'd look into that as well and potentially look at, say, okay, which one is a better one, which one has a lower MER, and then move to sort of consolidate some of that, which would then free up some capital to then look at some of these other, whether it's a thematic ETF or some of the other stocks that we have. So like a lot of portfolios here in Australia aren't diversified, which is what Tick, you've done that, but also a lot of other portfolios don't have a lot of international exposure. So I think you're doing really well on what's going on there. I just think it needs to be consolidated a little bit, and then sort of get those weightings a little bit better. Generally, we like to have a 5% weighting in any one stock in a portfolio, and no more than 10 to 20% in one stock or one ETF. Okay, so if that helps a little bit to sort of look at sort of the highest the portfolio position to the lowest, that's where you could probably do some topping up and moving around.
What is the reason
okay.
for no more than 10 to 20%, just for those who might have, in this situation, 35?
Yeah, so portfolio risk. So if you've got 50% of your portfolio in one stock now, let's go back to the Australian market, if it was Nvidia, fantastic, happy days. If it was Commonwealth Bank, happy days, you would have been doing very well. But what happens when that stock, Nvidia, falls by 20, 40, 50, 60? All of a sudden your portfolio is very much concentrated into one stock, 20% plus. That will then doesn't allow for that diversification. If one falls over, that's okay because I've got another 10 that are doing all right. That's one stock that will really pull down the performance of the portfolio. So it's just concentration risk, pretty much.
So Noah, how does that general advice sound? And I guess, do you have any questions for Dawesy while you've got him?
Yeah, I was about to say, so Adam, you would hate the VDHG and like all the DHHFs of the world. You're not a big fan of one in, all in, of a diversified ETF.
No, I think they do represent a good place in a portfolio if it's thought out correctly. And so the high growth one, I think the Vanguard one probably is the better of the two, but I'd let you make your own decision on that. It does offer some growth, and it does offer that. It's either you put all your money into that kind of thing and just let it sit there because it is that asset allocation kind of ETF, or you could use it for some kind of the growth component, but making sure you look under the hood of the ETF, looking at their weightings, looking at understanding what's in the portfolio. That will then allow you to then be able to then go around the outside of that to build the portfolio in a correct manner. So instead of the sort of the shotgun approach or the dart on the or you can pin the tail on the dog kind of thing, you've actually got some strategy behind what you're doing. And I think that's where a lot of people, like you say, I just found this new ETF, it looked good, so I bought some. So going back and then actually stripping it back and actually going and looking at the fact sheets, going and look at the website, looking at their top 10 holdings, look at all of their holdings because you can pull all of that out. And then from there, using that as a base to then build the portfolio around that. So I don't mind them. I think that they're fine. What was the reason for Latin Resources? I mean, I know it's lithium, but was it just it's because it's a sort of a decent size of the portfolio. Is it has it grown or is it, yeah?
Yeah, I bought that quite like a couple years ago, like for cents on the dollar.
Right.
And it's just kind of taken off. And it's kind of right now just a bit of, do I pull the trigger and sell, or can it make me retire? Do I have to be mucking around with ETFs?
So obviously lithium's in a tough space at the moment. I don't think that lithium is going to continue. Like the story behind it, the thematic behind it is actually very, very good. What I recommend to people that have had such a good run on certain things is that you take your original capital out. Let's say you bought it for $10. It's now worth $20. You take that $10 out. Now, if it goes to $100, happy days, you've still got some stock in it. If it goes to zero, you've kept your capital, and you're then using that capital then to go and buy something else. Does that make sense? So
yeah, 100%.
De-risking the portfolio. So take what you've got out of Latin Resources, take out your capital, use that to go for somewhere else, and then yes, you can retire on this thing because it is going to be longer, and you've got stock in it, and it's at no cost to you.
That's what I want to hear. It's going to the moon. Thank you.
Personal advice. Please seek professional advice before you do anything.
Yeah, no, I think it's especially with those ETFs, like how I've just got a few at the bottom. It's pulling that trigger and actually selling, and then re-diversifying and just fixing up those weightings. I think that's, and especially what a lot of your listeners have struggled with as well, is pushing that sell button and realizing potential mistakes, and then
you do get emotionally attached to stocks, right? Yeah. And that's where a professional comes in who doesn't have that emotional attachment and can look at it and give you that sort of, this is what you need to do, because that's the key to being quite successful in the share market, is not to get emotionally attached. And the IVV, I can guarantee you're emotionally attached to that one because it's been a cracker. So it's tough to then reduce or re-weight, but looking to take out your initial capital is a really good idea, because that then gives you some more capital then to put somewhere else and for that to grow as well.
Nice.
Okay. Fantastic.
Well, I think that's probably a good spot to finish. Noah, I hope you got a few ideas to go away and think about. But I think, yeah, everyone listening at home, as Ren said at the top, this is certainly how a lot of us started our investing journey. A bit of flavor of the month, and now we're dealing with portfolios that need a bit of cleaning up. But yes, thank you so much, Noah, for submitting to Pimp My Portfolio. We really appreciate it.
No, perfect. Thanks for the insight, guys.
If you'd like to submit to Pimp My Portfolio, head to equitymates.com/contact, and all the information will be there. Similarly, if you would like to chat to Adam, Dawes, or any of our advisors, head to equitymates.com/advice, and there's a form that you can fill in there, and we will put you in contact with Adam and the team. But Adam, thank you so much. It's been a pleasure.
Yeah, thanks so much.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.